Hey everyone, it's September 11th, 2015. I wanted to make a second video this week simply because I left out or did not mention a few things in my first weekly video. And with the Federal Reserve meeting next week, most eyes focused in on what the Federal Reserve may or may not do as far as interest rates are concerned. I think what I'm about to mention is important, and hopefully, again, it helps you assess markets or assess market conditions in a far better manner. Um, the first point I want to mention is that what matters is not by how much the Federal Reserve decides to raise interest rates, if it decides to raise interest rates. Uh, it's pretty much factored in as of now that a quarter of a percent rate hike is coming. Some people like to see the Fed move by as much as 0.5%, simply just to get all of these or all of this uncertainty out of the way, at least for the next 6 to 12 months. Another one, other people are saying that the Fed can't rise interest rates uh, and won't be able to do so until 2017. Even some projections as far as 2019. Um, again, what matters, at least from my perspective, is the trajectory um, of these interest rate hikes. Not just obviously for the remainder of this year and into next year, but into 2020, 2025. That's what's going to matter. Um, as you all know, a quarter or even a 0.5% rate hike doesn't affect the economy all that much. So, you know, when I read or hear people say that or put so much emphasis on a quarter of a 0.5% rate hike, it's just baffling how that could possibly, or how just such a small fraction of a change in a key lending rate will shift the what you call it the I guess the investment expectations most people have. Of course, it does affect the reserve ratios banks have uh, with the central bank. It does affect many of the carry trades that have been placed since 2009, 2010. Yes, it does affect part of the world economy as far as trade is concerned, and there's a few other elements at play. I'm not dismissing any of those, but again, I just don't see unless we see a meaningful rate hike of over a percent, even at 1.5%. I just don't see how a quarter percent rate hike is uh, is that meaningful either way. If you're a bull or a bear, so it doesn't really matter. But to that end, quickly on the S&P 500, the S&P 500 has to hold, and I've said this a million times, 1910 to 1920 on a weekly or and monthly basis. Any closing below this price band on any given week or in month on high volume will trigger a move down to this time rate, which I mentioned in last week's video, at around 1840. Can not coincidentally, but this actually there's a reason for it being here at this point in time. But coincidentally, if you want to see it like that, this time rate pegs the price point many investors are targeting or expecting markets to trade down to, be it over the next few weeks or months. I mean, at this point, it's some people are just calling for 1800, 1700 in the S&P. Other people are calling for 21, 2200. So all these predictions are up in the air. But um, the reason I'm pointing this out is because 1820 is not just a reactionary low we got in October and just last week, but it also comes right in line with this time rate. So if everyone is expecting the S&P to trade down or to at the very least retest the lows at 1840, 1850, then it becomes a self-fulfilling prophecy, and eventually it will happen. The problem with that is that since most people are expecting it, or bank or discounting the expectation of said event happening, you're not going to make as much money as you would expect on that downdraft. And this is I think the most important point you can take away from this week's video, and that's why I felt compelled in sharing with you. If the market does fall to 1840, 1820, and most people are in that trade, it reduces the amount of profit you stand to make. And since volatility is already high and likely to increase even more should the S&P decline down to this level, remember how I mentioned on last week's video that today, holding all else constant, ceteris paribus, right? You're being asked to pay 30% more on average on both the call and put side. There's a slight skew to the put side where you're even paying more for puts. That's in part because puts tend to appreciate more over a given time period or a given time frame than calls. And since we're in a downtrending market or in a market that has biased to the bearish side, those puts are priced even higher than calls for that reason, for the reason I just explained. So again, if the S&P were to trade down to 1840, 1860, right, and everyone's uh, wish gets granted, your profit is going to be reduced significantly, and you may not even make money on the standard floor. Again, way too many people are in the trade, right? So when it comes down to cashing out or realizing a profit, you're competing with other people who are in the same trade, trying to nick and dime each other to death, trying to get out of a trade. And for every trade, there's a winner and a loser. So not everyone can be a winner trying to get out at the same price. That's why you come up with these reduced profit figure. And the second point again is the high in volatility. So because you're already being asked to pay 30% more on average on both ends of the ledger, even if the markets decline further, your profits are going to be eroded by that theta factor that is higher than usual, right, or than the historical average. So because you have both of these market forces working against you, my best advice is if the S&P were to trade below 1910 to 1920, if you still have any longs, be it in growth and value, whatever it may be, right, in junk and whatever you're in, I would personally get out, sit in cash. I've said, I made it clear that last week's video that cash is a position. I would simply sell everything, not even try to short it for the reasons I just mentioned, and wait to see how this level holds. If this level has some support, then you might get back into the market or give it a second look. If it doesn't, again, there's no reason to be involved in the market. You can expect the market to trade down to 1780, which was an important fib retracement I mentioned last week. And if that doesn't hold, then we will come down to retest this time rate, which is the 1660 to 1680 time rate I've mentioned over the last 2 weeks now. This point is what I would be very interested in starting new positions. Doesn't mean I would jump in with 2 feet, but at 1640, 1680, or 1660 to 1680, it's a much better opportunity to go long if it presents itself. From there, the other price point that I would be interested is the former high, 2007 high at 1572. So in other words, if a market decline happens, I would not short it, simply because for the reasons I already mentioned, I'm not going to go over them again. I would stay in cash. Yes, you will have to wait a few weeks, maybe even a few months before you get your ideal price points, but that's better than losing money, right? And I would wait initially for this retest of the low, which everyone is expecting to happen, to see how markets behave. If not, I'll wait for 1780 for further clues. If that doesn't hold, then at this level, and only at this level, will I begin to nibble in with 1575, somewhere around here. Excuse me, 1575 at the as the lower barrier of where I would get more increasingly bullish or more risk oriented, if you want to see it that way. So that's the thing I wanted to mention. And the last thing is on the euro. The euro was a story du jour. Um, from late winter, or really from winter to spring. The move from in the euro from let me see, from a buck 39 and change down to a buck 04. Had everybody mesmerized for one, and it showed that clearly the ECB was intervening here in this market, right? It wasn't just short selling that triggered this move. I mean, most technicians would view this as a bearish flag formation, and it is. But just because it's a bearish flag formation doesn't mean lower prices are ahead. They could be, but you would need to break below support. Interestingly, and the reason I'm breaking up the euros because one, the euro has not been discussed as much as it was discussed just a few months back in spring, even though it holds as much weight, if not much more weight than oil. What I found interesting is that a couple of weeks ago, when the markets broke down, people flocked into the euro as a way of getting some protection instead of the dollar. Usually, people buy or flock into bonds or the U.S. dollar in times of distress. And to see the euro rally when markets fell tells you two things. One, the risk people are discounting is in U.S. stocks and U.S. equities. That's why people are going into the euro or the foreign currency, right? Even though the euro is by all means, all intentions and purposes, structurally weaker or weaker currency than the dollar. Doesn't make sense at all. In other words, people are buying euros for the wrong reasons, but it's the right trade given what people's mindset are as far as market conditions. In other words, the risk, which most people associate with a Fed rate hike, is giving people more reasons to sell U.S. equities against their counterparts in Europe. Again, it's for the wrong reasons. It doesn't make sense, but it's a trade most people have on today. You have to stick with it as long as it's there, right? But on the euro, anything above 116, 118 is problematic for the ECB and the Europe's economy. I'm sure once the euro gets even as high as 120, 122, you'll start to see some type of intervention to bring it lower. Uh, a lot of people are still net short euros down here. There's also been a few traders that have been buying into these dips. So the euro for now, I mean, at least shorter term, is just a no trade. But again, the reason I'm bringing it up is because should U.S. equities sell off next week as a result of or as an excuse of what the Fed does or does not do or say or whatever, watch for the euro. I mean, that could be the trade um, you should focus in on, at least for a short term trade. So that's what I found interesting. Um, so not to bore you, just quickly wanted to touch on those points and remind you that again, at least from my perspective, markets are behaving in the wrong ways and are acting on the wrong reasons. Yet that's the trade that's been making money. That will have to change. Will soon change once people realize what the real threat is, uh, and price different equities and whatnot accordingly. Um, what I would caution again, this is not a market as tempting as it may be to short. I wouldn't short it personally. If I see markets breaking down, I'm simply going to step out, sit in cash, and wait for those price points which I mentioned before to come in line. If they do, I'm not saying I'm not saying 1660 or 1680 is going to get tested, or even as low as 1575. It may happen, but if it does, then I'll have the means and I'll be opportunistic is what I'm trying to say, and nibble in at those prices where I see a higher rate of return on my money over time. Again, I just don't find it equitable nor profitable to trade this market to the short side should it break lower. Uh, so that's that. Uh, Again, be very careful. I have been having this feeling for quite a while that this is a market where they're trying to trick you in every way they possibly can to basically juke you out of your position and to make you a mistake. To force you to make a mistake. Once you make one or two mistakes, it's very hard to get out of that rut and reestablish yourself. So if you notice one or two of your trades have not gone in your direction, especially with market conditions as they are today, again, my best advice is sit on cash. Wait for a clear trend to emerge, whether it be at lower prices or at higher prices, doesn't matter. So that's that. Again, be careful, trade safe. Um, the Fed, for all we know, the Fed may be a non-event. I mean, equities may still be mired between I mean, excuse me, between 1840 and 2133, which is the range I've long I've long highlighted. Would possibly, or the S&P would possibly trade in and out of. We could very still trade in that range from here till year end. Again, and the Fed rate hike is nothing more than a non-event where people discounted negative aftershock in U.S. equities and price VIX higher, way higher accordingly. So it could just be a way of juking, of squeezing premiums and selling time in exchange for price as we head into year end. So that's another possibility. Again, there's a lot of moving factors. There's a lot of things to consider, and I try to cover one of the most important points to some degree in these weekly videos. So hopefully this will help you. I'll talk to you next week um, after the Fed meeting, and we'll see what markets do, if anything, and what could possibly take shape afterwards. Again, cash is a position. You're probably laughing at the way I'm saying this. You're probably laughing at how repetitive I am in some of the points. But if you're like me, I have to be told not one time or two times, but 10 times the same point over and over again for me to truly understand its meaning or its worth. So that's why I'm so repetitive in some of these issues, and hopefully again it sticks because they do matter. Uh, so I'll talk to you next week. Again, trade safe.